Welcome to Markets Now. I'm Michelle Rook along with John Payne with Hedge Point Global Markets. We ended higher in soybeans, mixed in corn and wheat futures, and it was kind of a mixed day over in the livestock as well, which we'll talk about in a moment. John, let's start off with the soybean market. Some double-digit gains. Was that because we missed rains in some key areas of the Midwest, or was that a demand push? The products had a pretty strong day.
I think it's the latter. The rains certainly matter, of course, but the sentiment of the market, I think, gets washed away a little bit here with first notice day approaching, and demand for the product markets is decent. In the case of oil specifically, just the RFS helps. So you have that implementing higher crush margins for the U.S. buyers of soybeans, and I think that's a bullish factor for a market like soybeans right now. Not so much for wheat. Where you're going to have the opposite factor. The market's in a pretty steep carry, while corn's in more of the middle, where you have July obviously is priced well above where the new crops are, but the basis out west specifically is really strong. So I look for fireworks here over the next 3 days before the report, and then we'll trade that next week.
So with the tight supplies that you talk about and the market still trading that inverse, commercials chasing after the July contract to try to take delivery, will this show up in tighter quarterly stocks or tighter inventory out there in that quarterly stocks number on Friday?
Well, the people who do the math for us don't think so. They don't think the stocks numbers will be much of a surprise, but that's why they're called surprises, And I think if you look at where we are, just given the margins, you look for maybe a little bit of a better stocks picture for soybeans. And in the case of wheat, just given the market action we've seen over the the first quarter, that I think that, the action we've seen over the second quarter, we've seen the wheat markets probably price themselves out of some demand. So I wouldn't be super bullish here on the wheat markets, even regardless of the price. Into the reports, I think specifically the new crop 24 KC is going to see a lot of acreage increases over the next year.
Of course, we kind of chased some of the headlines early on in the session about the Wagner Group and what was happening there in terms of them threatening the export channel for Russia. We didn't trade that very long. Did the market just come to grips that wasn't a big story, or did we get weighed on by the export inspections, or what happened in the wheat market today?
Well, I think it's a blessing for people in the business that we didn't trade Saturday, because you would have seen a huge amount of volume. I imagine a lot of speculators get into those market stories, and by lunchtime, maybe a little later, the thing had disappeared. So I for one don't really follow much of the Russian markets, not the Russian news flow, because for one, it's not a great intelligence source. And I was in the military and did a little bit of work intelligence wise. And you've got to triangulate things when you're in situations where you don't have good sources. So you've got to find a story, and then you almost work backwards. And for me, it just didn't seem like anybody knew what they were talking about. So the market, the best thing to do is just kind of turn it off in those situations. So I think in the case of wheat, we're trading physical stories right now with the first notice day approaching. I think the Wagner Group certainly matters longer term. There's a geopolitical theme that can push wheat, but in regards to the overall Black Sea supply picture, we're still trading $200, $215 a metric ton. And until that changes, I'm not going to worry about wheat markets, because at this point it's available, it's cheap, and the U.S. isn't getting into that business.
Corn ended mixed on Monday. John, do you think that the market was kind of disappointed with the rain coverage over the weekend?
I think to a degree. There's certain areas in central Illinois that didn't get anything. I don't know the numbers, Michelle, you've heard folks trading, but I would assume, let's just talk about a 170 would be maybe the areas that we're looking at right now. And you're still looking at a stocks to use number that would be around 10%. And that's without many demand cuts. So I think at this point, you're now looking, can we be worse than 170? Those areas are going to come from Illinois. If we had a huge major crop failure in Illinois, we would have issues, obviously, with that number. But the rains hit, at least in Iowa, from what we saw on the radar. I'm sure you can get plenty of comments that'll say it didn't. But I think at this point, our numbers are kind of zeroing in on 170, plus or minus five bushels to the acre.
Do you expect a drop in crop ratings this afternoon? Is the market programmed that in already, or what?
Well, we were surprised last week that we got the drop. So I kind of prepare myself this week that they'll do it again. you talk to the farmers, things certainly aren't rosy. And just for me, anecdotally, I talk to people who are in the business or, read newspapers in the Midwest or actually live in the Midwest, and they'll say, hey, it's really dry here now. And for me, the contrarian kind of my red flags pop up a little bit. And it's like, well, the public is now on it. So I'm a little careful here to be chasing any weather stories above $6, just given the demand story. Personally, I'd rather look at next year. If you're bullish corn, if you think this crop isn't there right now, the value exists down the curve, because that's where the export buyers can get value and they can buy U.S. product before it still makes sense.
So you mentioned first notice date coming up at the end of the week, but we also have end of the quarter, we have end of the month, and we have these big reports coming out. How explosive could it get? And talk about what you are anticipating. Is acreage going to take the headlines or dominate the headlines again on Friday?
Well, I don't know. I mean, I don't want to curb the question. My opinion, really, I'd rather just pick it out of a hat, because I think that's what can happen. Just my history in this being, in traveling over the summers, you just recall going into 4th of July weekends where the market moves sharply on these reports. It's always this weekend before the 4th. So you get, the bullish scenario would be you get a really bullish stocks number. Maybe we found some supply that disappeared. And this is where the feed numbers can kind of be, the USDA can, not saying they fudge it, but there isn't a lot of auditing that can be done to say, hey, how much has been consumed via industrial use and things like that, where we can on the exports. But at this point, you get that combined with an acreage drop, combined with bullish weather. That's where you could get the kind of 2012 effect, where it just legged up from the 4th of July. I think the weather could kind of be there, just depending on what models you read. It's going to warm up, which is something we haven't had in the Midwest. But I kind of look for the latter to happen, where they maybe increase the corn acreage. It'd be bullish beans, increase the corn acreage, keep the demand steady or even drop it. And then you have weather that's pretty good after the 4th. And all of a sudden you find yourself, the P&W corn is $2.90 a metric ton. We're trading out of Argentina for $200 a metric ton. So that's almost $3, $2.75, 260 cents difference that I think could come out of the market rather quickly.
So cattle market mostly lower. We did have maybe a little bearishness in the cattle on feed report, but we had already seen this market kind of roll over prior to that with lower cash and boxes. Do you anticipate that's going to continue?
Well, I do. I think that the cash price for beef will continue to inch lower through Q2 or Q3 rather. So, down into August 1, September 1, I think beef is going to struggle to really do what it did a couple of years ago, where it kind of double topped into August. Those are economics, demand more pushing. I think on the feedlot side of things, if you are bullish cattle, there's some opportunities here in the live. And I know it's like, wow, can you go out and buy 175, April 24 live cattle? Does that make a lot of sense? But the folks I've talked to in the business would say that it's not going to work at 174. So there's not going to be a lot of demand to sell it there, because these animals are, they're fetching for well above that when it comes to replacements and when it comes to, the physical side of it. So on the board, I almost like the live side more than the feeders, but the feeders are tied up in this grain trade. And if the grain trade works out and we have supply of feed, feeders could simply just jump right back up to that 245 level pretty quickly.
Okay, we'll watch. Hog markets had a nice run off the lows. Another pretty good day here today. Some of that has been driven by short covering by the funds. But what is the real underlying story that started that or sparked that short covering, do you think?
Well, I think the sell-off was a Prop 12 deal. At least that's kind of what I've assumed post the report. We got a big sell-off following the numbers, but the market had really sold off before that. I was thinking it was China more than anything. We've had a tough Chinese market, but all in all, it's not, at this point, I think the Prop 12 trades behind us, and now we kind of can trade a little more normally, and I'll use that in air quotes, that we have some certainty around what the state of California is going to do in the short term, and that is simply not abandon demand. So you still look at where prices are in the deferreds, the Q3, Q4 prices like October, December, and February are going to be tough roads to hoe here without a big supply shortage. I just don't think the demand is there for it. At least the retailers haven't wanted to feature pork. Maybe that changes, but at this point, demand seems to be somewhat sideways on the export side. And, spec demand probably is covered a lot as well.
And what's your anticipation? We do have a hog and pig report coming out here on Wednesday. Will we see some liquidation?
Yes, I think we're thinking about a 0.5% year over year drop in all hogs and pigs. If it's less than that, you certainly could see more downside price action with the idea more sows are to be liquidated. If it's better than we expected, or at least like 0.7, 0.8, you might see the market really jump, especially in the front. So right now, I think that the markets I mentioned are the ones that are difficult, especially given where we were. I mean, we were just down at sub $80 on the August and July, and now you have October. I'm sorry, October and December, not December, but October and February trading north of 80. And those in the 2019, 2018, 2017 markets were really good sales. So right now, I think a lot of it just depends on your view in China and feed. And right now, we'll have to kind of watch and see, at least on the feed side.
All right. Thanks for joining us, John Payne with Hedge Point Global Markets. That's Markets Now.